We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Avril Hong in Singapore.
Good Monday morning. I'm David Ingles here in Hong Kong. Let's get to your top stories today. A risk-off mood, as you can see on our screens here. Starting off the week, we had a weaker than expected jobs reports. Revisions included there, boosting havens and also boosting bets for a September Fed rate cut. Now, oil prices are under pressure after OPEC and its allies agree to further boost supply, fully reversing cutbacks made back in 2023. And we take a deep dive into Hong Kong's stablecoin legislation as the financial hub seeks to offer an alternative in a sector dominated by the US dollar. Good morning once again. Thank you for taking the time to join us. As you can see, stocks are continuing to come off, I should note, extending really the losses, the steep losses we had going into the U.S. close on Friday. All that being mentioned, as you can see, U.S. futures are indicating that the losses will have a limit at some point today, and we're up 1/3%. TAIEX is coming online, 0.9% to the downside across a couple of other markets that are coming online this hour, including, of course, Greater China. 1.8% is the damage across the Topics Index. That takes us into really the big macro story, which we're still feeling this part of the world. And the rally in the bond markets. The 10s are coming up on your screens, an update of the 2 and 10 in the U.S. Treasury market following what was really a more than a 3 sigma move on Friday on yields to the downside. And suddenly we're here staring at an 88 to 90% probability that the Fed does move this time, well, in their meeting in September. 370 right now is your 2-year yield. As you can see, we're down across the Japanese and the New Zealand 10-year yield. Keep in mind, Oz, of course, is close. Just keep in mind. Okay, very quickly, the dollar story, despite the weakness post the jobs report on Friday, all things equal, we still saw the biggest drop, weekly gain rather there on the Bloomberg Dollar Index in all of 2025. The bottom of your screen is still 12.11 right now on the Bloomberg gauge. We'll unpack the OPEC story for you in a moment. Goldman Sachs has some commentary coming through there on the back of the news on the weekend. And the approach going into the open today, and we'll talk more about the key themes in this Chinese market, including, number one, intervention out of the Hong Kong dollar, HKMA on Friday. We'll look at the fix today, plus, of course, we are entering a fairly decent earnings week, plus key levels in focus following declines. Suffice to say that level you see bottom of your screens is the next support level on both those benchmarks, which could be in play given, as you can see, declines, Avril, going into the open today.
Yeah, and certainly some questions as well, what the next sort of catalyst is going to be in the absence of stimulus, in the absence of a trade deal between Beijing and Washington. And we're also seeing these signs that the economic growth has been slowing for the month of July, right, after a pretty resilient second quarter. So begs the question what all this is going to mean as well for global oil demand.
Yeah, it does. And I think when you look at all the signs currently, that's the tricky part, right? Morgan Stanley will be joining us in a couple of minutes. And what they're saying is the revisions we've seen in the jobs report, which I know you'll talk about, will reflect the weakness ahead in the pipeline that goes into the OPEC story overnight, with Goldman Sachs, of course, coming out and reiterating their forecast there on oil prices. But suffice to say, the bottom line coming through in the revisions on the jobs front, Avril, and also the point that Morgan Stanley will be making a bit later on is that the tariff impact is still in the pipeline, and that is expected to show up in the next few months. And I guess that does underscore, of course, the less need for more oil in this market. The jobs report, of course, was the big one we're going into today, as you were pointing out, Avril.
Yeah, massive job shocker. And you mentioned how U.S. markets performed today. We're seeing the extension of declines in the Asia session. Really that big miss on job creation out of the U.S. and then downward revisions for the months of May and June. Trump fired the BLS chief as well. And this all kind of coincided later in the session with the early exit of Fed Governor Adriana Kugler. So all in feeding into what we might see from the Fed next month.
Yeah, it's going to be a bit more difficult, really, to price macro changes, I guess, it's the big question there. But certainly when you look at the pricing across Fed fund futures, or if swaps is the way you're looking at that, it's about an 88% to 91% probability right now that markets are pricing in for a Fed rate cut in September. This is, of course, a moving target, but suffice to say it's more than a base case in September. We're getting a little bit more than 2 rate cuts priced for the rest of this year. And again, on the note that Avril just mentioned there, I recall, if you guys recall that joke that Tom Cruise made in one of the talk shows, he said he described the stunt to his safety guy. His safety guy said, no, it's not safe enough. So he got another safety guy, right? Will replacing the person in charge of statistics change the underlying statistics is the question. And why are markets treating this as a risk-off event? Chris Weston is with us to help us answer many of those questions, head of research at Pepperstone Group. Chris, big drop on equities on Friday. We're feeling that in your Asia Pacific. Does the price action make sense to you?
Yeah, I mean, it does. I mean, I think, you got a market that was so short of volatility, overriding strategies on the short end, short-dated 10 years had been very much in vogue. And, we'd seen very, very, very low realised volatility in the S&P. I mean, S&P 10-day realised vol was at, I think, got down to about 4, just under 5%. And because of all those short vol strategies, dealers were long gamma, and I think that's obviously being looked at very, very closely at the moment. The market, was quite impervious to kind of any kind of shocks to the system. But I think the news on the payrolls has brought in an element of left tail risk back into the market, and obviously those volatility structures are being looked at very closely. The gamma structures need to be dealt with and hedged and or unwound potentially. But I think, yes, with the magnitude of the revisions that got everyone talking, the removal of the BLS chief was, I think, is a big deal for markets. You talked about the data. The data does need to be looked at. It's the methodologies, very much in the spotlight. The recipient, the number of people replying back to these surveys is dropping. Has been in structural decline for quite some time, and that's what we use to price risk. And you look at the data in the US. The BLS are in charge of the CPI compilation, and the $2.1 trillion tips market is very much based on that as well. And that has us trying to understand exactly how we price risk and understand economics and forecast economics and make the correct assumptions when the data at our disposal is, prone to inaccuracies as well. And that makes, wearing out a high risk premium in this market. So yes, absolutely, I think it does make sense. The question now after the payrolls number is, we've seen shocks to the labour market over the last couple of years. We've seen them, last year, I think we talked about the Pham ruling, and we saw 3 sub-100 payrolls numbers. Are we likely to see another scare that doesn't, actually eventuate to anything with the unemployment rate going higher? Or is this a situation now where we do need to really consider about, a slowdown in the labour market, higher unemployment, of which I think is a really big deal for markets? And I think that's the question where we're starting to see the distribution change a little bit, that option structure change, and I think it does need a higher volatility in this market.
So, Chris, the alternatives, though, to markets trying to price and figure out macro risk, for example, I mean, it's not like we have an alternative. So I guess my question is, how important do you think the next set of jobs numbers will be this time next month, and what else do you think could change this narrative that the Fed cuts in September then?
Well, I think you're right. I mean, we're not going to get a new BLS chief ahead of the CPI print. We're certainly not going to, we may get it by the next payrolls print on the 5th of September. But I think even if you were to put someone in place now, the methodology is not going to change. I mean, it's an old school way of compiling data. It hasn't sort of kept up with the technological changes that we've been seeing. As I say, the survey replies have dropped markedly. I mean, back in 2012, I think we saw a recipient rate of about 63%. That's dropped down to about 48%. So there's structural issues that needed addressing anyway. But now coming out and politicising, the people who are actually compiling the data is something that has gone under the radar. It's all been about politicizing the Fed. Now we're actually looking at, how this actually transcends into the data. And will someone come in who obviously, has us questioning the efficacies there once again and window dressing the samples effectively to try and make the labour market better. I will say that, obviously, if you go back to the European model of collecting inflation, I'm getting off topic a little bit, but the way they use HICP is perhaps a better way of doing things, and actually would bring down inflation in the US by 20 to 30 basis points. So that's an interesting thing. But obviously, we're not going to get someone in place by that time. And you're right, this is what we have to go by, and that's where we price risk, and the algos will continue to trade straight off the outcome off the bat. But given, as I say, we have had these unemployment scares before over the last couple of years, and they've mostly been false starts. The next one will be very critical. Obviously, we looked at the level of job creation from healthcare. You take that out, we've got poor jobs creation. And I think, the market is going to be buying volatility around that non-farm payrolls on the 5th of September, because it will potentially open up a 50 basis point debate.
Yeah, and markets somehow still just pricing in 25 for next month. But Chris, wanted to ask you as well, we're seeing some undermining of confidence in US data at a time when Fed's autonomy, there are really these swirling concerns. What is this going to mean for, the comeback in US exceptionalism?
We were looking last week at potentially signs that it could be coming back. Excuse me. We'd seen some pretty good earnings. I talked about implied volatility in the S&P being very low, but we're in a single stock level. It's actually been pretty high. One-day moves have been the highest we've seen for a long time. But the earnings were pretty good. The number of companies beating have been better. We've been looking at the AI story again. That was really outperforming, and that was obviously at the crux of the exceptionalism story. And there's a capex boom that's obviously clearly going through in America at the moment. We've seen that from the hyperscalers and their new commitment to capital, which does give the exceptionalism story, just a little bit of vigor. But I think also at the heart of this now is the unpredictable policy settings we've been seeing. And I think Trump's move to fire the Bill S chief really doesn't do that any favours. So I think if you're a real money account, a corporate entity who are looking at those hedging ratios, or certainly on the real money side for foreign investments, you're probably looking at those ratios again and looking to continue to take down that dollar exposure. Of course, the hedge funds and the speculative accounts will continue to watch what real money do. If they look at those hedge ratios on euro dollar, for example, and yen and into yen, they will trade that, and that will continue pushing the US dollar down. I do think the rate stories are probably a little bit on the FX side. Sorry, is fully priced now. For now, I don't think the data this week is going to change that too much. And we really need to wait till the CPI print, obviously Jackson Hole. But I think the exceptional story was looking okay last week. I think some of the more erratic nature of the policy settings again is just to, does have people reviewing that situation once more.
At the same time, we were watching the dollar making a sort of comeback bounce in the month of July. Do you see from here on out, there's a bit of a distinction between the way it performs versus EM currencies versus DMs?
Well, absolutely. I mean, I think you're obviously going to trade with a different beta, and it really depends if you're in there for the carry side of things. I mean, I don't think you're looking at the US dollar as a carry play at the moment, because, you're probably looking at it on a volatility adjusted basis and seeing it less compelling on the back of that. But I think, I think this is now a broad US dollar move. We've got 80% for September priced. I think that's fair at the moment until we go into CPI and then obviously Jackson Hole. I think the terminal pricing is really what you want to be looking at. If you look into SOFR Reds at the moment, we're sort of calling a trough Fed funds rate around sort of 3%. I think that's really key. I think the market, if we were to see some weaker data from here, if you go below 3% and we start talking 280 in that sort of longer ended of the Reds, I think that's the market showing you or telling us that the recession probabilities will increase. At the moment, obviously, we're pricing some 15-20% implied probability of a recession over the 12 months, but it's a moving target. And I think, one-year rates or SOFR spreads are going to tell you how they're feeling about that. I think if we go below 3%, are you going to think you're probably going to get a broad US dollar sell-off playing through? So, pick your poison. But we are seeing spreads come in favour of dollar selling, and one-year rates have come in markedly recently. So I think this is a broad US dollar story. And as I say, I think we have had some scares before in the unemployment rate, but perhaps this time is a different situation. And I think that's the question that people are asking this time around. And if we get more evidence of that, SOFR goes below 3%, I think the US dollar goes down on a broad basis.
All right. And Chris, I guess next time, we'll save this for next time. It's time to look at high yield, perhaps as a leading indicator, really, of whether or not markets have fully priced, of course, the tariff impact. Chris Weston, fantastic. Thank you so much for getting us warmed up here for the week. Head of Research at Pepperstone Group. Just ahead here in shows, we're speaking with Morgan Stanley about China's campaign against excessive competition, the impact of Trump's tariffs. Interesting two reports they put out. And also coming through later, an exclusive with the Asia CEO of Vietnamese EV maker Vinfast as they open their first factory in India. Counting down to the open of trade in Shanghai, in Shenzhen, and here in Hong Kong, where it's still an extremely hot, humid, and wet morning. The amber rainstorm warning, though, was lifted a few minutes back. Doesn't change, though, the situation quite literally on the ground. The opening bell 14 minutes away. This is the China Show.
Couple of things they're watching in the Greater China region today, of course, as David was mentioning earlier, those support levels, 50-day moving average for the Hang Seng China. A couple of sectors we are keeping tabs on as well, including EVs, after a number of them release sales data which showed a slowing. Question marks about whether the likes of BYD are going to be able to meet their annual target. Oil, energy stocks overall also in focus after OPEC's supply hike. And then, of course, we also got that yuan fix a short while ago, I think below the 714 level on dollar yuan fix. Hong Kong dollar weakness also seeping through against the backdrop of that slide in the dollar. David?
Yep. And yeah, I mean, certainly a lot of things to note there. And I think some of the things that April just mentioned, including CLP, which reports today, and it takes us into the preview of this week. Some big earnings are set to drop on this market. Also, some not too big earnings, but that, clearly we can talk about that next time. Didn't make the graphic, though. But yes, Cathay Pacific, Swire Pacific, a couple of semiconductor plays are set to report results this week. We also talked about a sector to watch, which is platform companies, and that's on the back of the guidance that we now understand coming out of the anti-monopoly regulator, has issued some information around fees, online platforms that they are now they're allowed to collect from merchants here. Let's bring in Min Min Lo, our China correspondent, to talk us through what the new guidelines are and what they say.
Yeah, so the new guidelines are meant to prevent these platform companies, there are only 3 of them, right, the big ones, to prevent them from, in some ways, abusing their power to force merchants to, for example, take part in promotions, essentially giving subsidies to either consumers or to the platform companies, if you think about it, and to prevent these platform companies from charging fees that should be borne by the platforms themselves. So these companies are now being asked to also publicize their charging fees and rules to prevent discrimination against these merchants. And of course, this is part of this broader theme the government has been harping on to rein in that disorderly price competition, a top priority coming right from the top from President Xi himself. And already we have seen a number of sectors, including the EV sector, the food delivery platform, and now the e-commerce companies that are in focus as well.
Now, I think it was this time on Friday that the NDRC came out and said they will start naming and shaming, of course, along these lines. So maybe incentivize companies not to do this, or disincentivize? What do we know about that? No.
Yeah, I guess this is one of the levers that the government has, because one of the concerns is that given that a lot of this competition is coming from private companies, what can the government do, right? So we have seen how the government, first of all, they asked the companies to self-regulate, and now they are saying they are going to name and shame them, so expose some of the worst offenders for public scrutiny. And I guess guess the third step would be eventually, if the breaches are very serious, they're going to start taking some punitive actions, but they didn't spell out what that would be. So we had already seen, for example, JD.com, Ele.me, Meituan, they had come out on Friday with statements pledging to end that low price competition. We saw the share prices rising on Friday. This is supposed to be good for industrial profits, and already we're starting to see early signs. If you look at the PMI on Friday, we saw contraction on the private survey, but you look at the sub-index, even though the sub-index for orders had gone down, but the sub-index for prices had gone up, and that's an early sign that perhaps this is already having an impact.
Yeah, and Min, addressing the price war issue, I think is also something that's helped the Hong Kong stock rally. Even though Hong Kong stocks are doing pretty well, all things considered, the government is easing these listing rules in the city. IPO market looking really buoyant there. What are the changes being implemented?
Yeah, this is part of broader measures to try to attract more companies to list in Hong Kong. So two big changes. One is that the minimum float requirement for mainland listed companies to do a secondary listing in Hong Kong has been reduced. So initially it was 15% of total number of shares that needs to be offered in Hong Kong for a listing to proceed. Now it's going to be lowered to 10%. And the second big change is that the allocation to retail investors is going to be dropped from 50% to 35%. What this does is that it gives institutional investors more power in pricing. Although in the past, if there had been a lot of demand from retail investors, there's also this clawback mechanism that allows reallocation to retail investors. The purpose is essentially to prevent overpricing during the book building process, which would increase the chances of a price slump after a listing. So, of course, all of this likely to make Hong Kong the premier destination, especially for Chinese listed companies, to seek a second listing, and part of the government's effort to make Hong Kong this top premier destination for financial investors globally.
Min, thank you so much. Bloomberg's China correspondent Min Lo for us there. And let's take a look as well at how futures are shaping up. We're seeing a bit of a downdraft, I think extension again from the losses on Friday. A lot to unpack, plenty more ahead. This is Bloomberg. Let's take a look at how Hong Kong is faring pre-market. A bit softer, that's the indication. Hang Seng Tech, I think, could be that drag as well. And of course, all this against the backdrop of that US jobs report shocker from Friday, and a lot of risk appetite, I guess, being taken off the table at the moment, David.
Yeah, being sucked out of this market. And I think when you look at some of the big names on your screens coming up shortly, and I think BYD is going to be very much in focus today. It's quite a steep drop in your pre-markets. We're down 3% on that yet. Some car sales numbers out in the weekend. On top of that, when you look at the price itself, post, of course, the corporate action that was announced back in June, at about 113 a pop, that takes us to the lowest level on the share price going back to early April. So it's really gone all the way up and then almost all the way back down if you look at it over a 4 or 5 month time horizon. Shenhua Energy will, and this was a filing with the Hong Kong Stock Exchange late on Friday. Shanghai shares are suspended. The company is proposing to buy some assets held by China Energy. We're looking at a coal asset, so keep an eye on that. Zijin Mining, big move up in gold on Friday. We're flat right now, 3,400 thereabouts. There is the futures price in Alibaba, of course, to the downside. Meituan, we're looking at that too, on the back of sort of the progress on the platform companies, which, by the way, will be a key topic of conversation with Chetan, Ahya out of Morgan Stanley. Anti-involution. On top of that, tariffs as well. Two big key areas of focus. The opening bell, a couple of minutes away. This is the China Show. Good morning. This is quite literally an interesting, almost complete opposite, juxtaposition of the weather. When you look at what seems to be a very hot, pleasant, maybe on the more humid side morning in Shanghai. And man, the terrible weekend we've had here in Hong Kong with the black rainstorm warning on Saturday. I don't think we got one on Sunday, but it certainly did feel like the same amount of rain and gust. And if you made your way into work this morning, you're probably drenched, and it's Cheap Tuesday, as we say here in Hong Kong. Although I have to say, April, the amber rainstorm warning was lifted going into the hour today. So that's silver lining, I guess. April.
Yeah, a bit of relief, I guess. We had gloomy weather over the weekend here in Singapore as well. But aside from that, let's take a look at how markets are shaping up at the open. You're seeing that decline on the CSI 300 as we still wait out for the US-China trade truce potential extension. Of course, this is a truce that runs out August 12th, and all this coming as data has already been showing us cracks, not just in the US economy, Chinese economy as well. So that's all playing out into trade today. You're seeing, I think, dollar China, we can take a look as well at this next page, tracking the moves in the greenback. As Chris Weston was highlighting earlier, it's a broad dollar move. So we're seeing dollar China below the 720 handle. We got a firm fix today as well from the PBOC. In the meantime, keeping tabs on the reaction perhaps to China issuing guidance on merchant fees set by online platforms. This is something that is coming into effect immediately. A draft of this was already pushed out in the month of May. All part of efforts to sort of address price wars. And speaking of, take a look at EV makers today, because we did get some of their sales numbers. And overall, on month, the likes of BYD, NIO as well, they've been showing that slowing growth in sales. So as we've been discussing earlier, for the likes of BYD, how's it going to meet its annual sales target? NIO, I think one of its model releases caused a lot of optimism, so going a bit of a different direction there. But the other stock that we're watching in Hong Kong as well is HKEX, because David, we also got Hong Kong easing listing rules for the city, and this is already on top of a really booming IPO market in the city.
Yeah, we're doing much better here in Hong Kong than you guys there in Singapore. Anyway, that's the competitive bit from my end today. But yes, we'll continue to track, of course, HKX, and certainly some changes there in terms of, I think, the float. And also what it means for institutional investors there. Now, this goes into, I guess, partly the trade conversation, which I think when you look at markets today, there are two themes, right, related themes. One is that massive drop on the two-year yield on Friday, 30 basis points, let's call it that, 30 basis points, 3 standard deviation drop on the U.S. two-year yield. That goes into the data in the U.S., of course, some changes there within the labor force, and then, of course, in charge of the Labor Department, their statistics. That goes into the tariff and trade conversation, right? Is there weakness that's coming through in the economy that we're now just starting to see, right? While we do have trade agreements taking place almost left and right, we still have, of course, some spots we need to fill. The U.S. Trade Representative, Jameson Gray, actually says that negotiations with China specifically are going well. Have a look.
They really focused on rare earth magnets and minerals. China has put a global control on the world. And so for the United States, we're focused on making sure that the flow of magnets from China to the United States and the adjacent supply chain can flow as freely as it did before the control. And I'd say we're about halfway there.
And to help us understand the now and the future implications of these trade negotiations, Chetan Ahya is here with us on set, Chief Asia Economist at Morgan Stanley. Good morning, sir.
Good morning.
Signal from noise is something that people have been trying to figure out, and markets have, to some extent, gotten some relief because we're getting trade deals here and there. You guys are of the thesis, though, that you guys are operating on is that we still have yet to see the actual impact, economic impact of everything that's going on.
Yeah, that's right. I think it reminds me of 2018, and I was in New York in my global role. We were analyzing the tariff impact from Trump administration in the first term. And if you remember, by the time we were in September, tariffs were imposed in July, announced in April, and markets were as if there is no impact of these tariffs on the economy. And then finally, eventually, when the numbers came out in November, data was slowing, and then there was a reaction that, oh, tariffs do matter. So I think it's something similar that is emerging We saw that in the Friday payrolls data in the US. If you see the trajectory of payrolls, it has been seen like it's having a clear impact from the time tariffs were imposed. And then we are expecting more to come through in the coming months and quarters. The reason why it happens is that, if you think about the capex decisions that the corporate sector is taking up, it doesn't cut down its investment spending immediately. It still continues through the capex it had announced before tariffs were imposed. And it takes about 4 or 5 months before capex slowdown begins to come through. And we are seeing that in Asia's capex data. We are tracking the capital goods imports data from the trade numbers because the GDP component of capex takes time.
Right.
And that has begun to slow down from the month of June quite meaningfully for Asia. And so we think that this is also coming to Asia in form of a big capex slowdown. And then there will be that reverberations of US slowdown on global trade and global trade slowdown as well. So this is all in pipeline.
Is that a late 2025 story? And as far as how and when it shows up in most of the numbers, or is it a more 2026 story at this point?
No, I think it's already started to come through from the month of June. So we would expect that every month from now on, you will see that downward.
It's worse and worse.
Exactly.
Okay, policy implications then. And is that apparent now to policymakers who are then looking at their own data and trying to figure out where their economy will be on almost on a month-to-month basis?
Yeah, absolutely. I think the job for Asian policymakers is somewhat easier because they are already dealing with lowflation problem. And at the same time, their growth has already been not that strong. So we think Asian central bankers have an easier way to take the decision to cut interest rates, and that's what we're expecting. But that's a policy option more to be used by Asia ex-China. China, we think, has relatively low interest rates, and so China will be using more fiscal policy, whereas Asia ex-China will be using more monetary policy to defend this trade and growth slowdown that is coming upon us.
Chetan, Avril in Singapore here, you talked about the capex slowdown. Where do you see that most pronounced at the moment in Asia?
So it's almost like across the board, and we are seeing that data in country-by-country basis on capital goods imports. So it's showing up in China, it's showing up in India, it's showing up in all the more trade-oriented, large, mid-sized economies like Korea. So yeah, it's kind of broad-based that we are seeing that. Taiwan is an exception as an economy, but you know that there is a completely different trajectory there because of the AI-related capex. But everywhere else in the region, we are beginning to see that capex slowdown coming in through.
Can you help us understand as well, amid all these moves in the currency, we've been seeing the dollar moves as well, how is that affecting perhaps import costs or export attractiveness net-net?
Yeah, so I think that's a good question. The question that I would rephrase it as who's bearing this tariff burden. So first of all, in terms of the total tariff value, it's looking like it's going to be $260 billion on Asia's exports that the U.S. will be charging. At this point of time, we are seeing that bulk of this burden is being taken care of by the U.S., whether it's U.S. importers or U.S. consumers. Asia has actually managed to increase prices in the last 2 months by about close to 2%. And the reason why Asian players are passing on this to the U.S. is because they have seen currency appreciate. And currency in the region on an average is appreciated by 4%. So they've said that, okay, out of that 4%, half of it is that the Asian exporters will take, and half of it they are additionally passing it on to the U.S. Importers. And the tariff burden will be on top of this. So you can see that as of now, it's largely being borne by the U.S. Now, over a period, it's possible that as demand softens, U.S. importers will push the Asian exporters to cut prices. But we reckon that it won't be like 2018. In 2018, currency depreciation took care of most of the tariff that were imposed on China. So in effect, nobody bore the burden. But in this cycle, we think it is going to be largely the U.S.
And Chetan, that brings us to my question is on transshipments and whether or not we have enough information to know really how they're going to implement this. And just for conceptual clarity, foreign value added, if you could just define that for our viewers in very simple terms. And based on your research and data, do any specific economies stand out that might be vulnerable as far as foreign value added is concerned?
So I think so when we looked at that analysis, so what we tried to do is who is more dependent on foreign, rather imported stuff to produce their output. And Vietnam and Thailand stood out. They are the ones which are more dependent on foreign imports for value addition in their own economy. And so that will be the one, those economies will be the one which will be at greater risk of this additional 40% tariff which the U.S. administration is talking about.
Okay. I want to shift gears to the other report, which is also quite interesting on anti-involution. Can it solve, a very simple question, can it solve the China's deflation problem?
Not really. We think that, demand side is more important. There is a knee-jerk reaction from the markets that, oh, this is similar to 2015 to 17. But I would like to remind that in 2015 to 17, what happened is you had seen a big reflation in the property sector. We had also seen a big recovery in global trade. So the demand side of the equation got taken care of. Yes, the supply reduction will help, but we think that, you need that demand support. And just one other big picture framework question that I am thinking about is that like when you think about China's current deflation problem, why are we here? We are here because whenever there is a downturn in the economy, whether it is property sector or exports, policymakers try to defend that growth target with more investment in manufacturing and infrastructure.
Right.
So unless there is a change in the thinking that, yes, we are now not going to give growth targets to the local governments to achieve, and at the same time, therefore, take up low investments in manufacturing and infrastructure, it will be very hard to completely get rid of this deflation challenge.
Chetan, when do you think maybe we will be seeing a bit more forceful stimulus as we kind of come up to the limits of some of the measures, including trade-in subsidy programs?
So as I mentioned, the real solution is, in the report, that real solution is to boost consumption. The idea behind that is that, look, you're going to see, if you're going to accept that you can't keep investing in manufacturing sector aggressively and infrastructure aggressively, and there is going to be a growth challenge because property sector is not going to come back. Global trade dynamics means that exports is not going to be strong. So how do you sort of manage the aggregate demand in the economy? And that should be done with consumption. The consumer trading program is a temporary solution, but we need a structural solution to China's demand problem. And for that, we have been highlighting that you need to have this social welfare program, which is targeted towards migrant workers. There are 300 million of them. It's bigger than a country like Indonesia. And there is no basis for us to think that why should this population be not getting the access to public healthcare, education, and housing. So if that is made available, they are running a saving ratio of 46%. Think of it, 46% for this migrant workers in terms of household saving rate. That compares to the nation's aggregate of 31%, India at 22%, and US at 5%. So there is a urgent need to address this social welfare support for the migrant workers. And as they do that, they will bring down the saving ratio, boost consumption on a structural basis.
Do you think the tariff impact has been or will be a big enough catalyst for these structural changes to unfold?
I think so, but I think it might take some time. I think the good news is that they have at least recognized that deflation is a problem. I know that we have a different terminology in China saying that it's anti-involution policies, but essentially at the heart of it is a recognition of the deflation problem. That deflation doesn't help the economy on a sustainable basis. And so I think that recognition is a good sign. However, as we discussed just now, I think we also need to see that there is an acceptance that we can accept lower real GDP growth, that we are going to actually boost demand with consumption. And then we are also going to cut back on the excess capacities which exist. So all of these three steps have to be taken up. And at this point of time, I think it's going to take some time before that recognition comes through.
It is as Chetan, you point out it is a structural issue more than anything else, which takes time. Thank you so much for taking the time to come in here. Of course, two things there. We mentioned the viewpoint on China and also the viewpoint on trade. Chetan Ahya, Chief Asia Economist at Morgan Stanley. Just ahead here on shows, we'll hear from longtime emerging markets investor Mark Mobius joins shows here. We'll discuss navigating the uncertainty. Ooh, that's something I haven't heard before. Navigating the uncertainty over President Trump's shifting tariff policy. That's coming up, of course, on the next show, Inside with Esme and Ahya. This is Bloomberg.
Some global news to get you up to speed with this morning as well. President Trump, as we've been discussing, has fired the Bureau of Labor Statistics Chief Erica McIntyre hours after the agency released weaker than expected jobs numbers. The president called the data rigged, claiming political bias. Economists from both major parties are slamming Trump's move as baseless. Tesla has been told to pay $243 million in a lawsuit over an autopilot crash in Florida that killed a young woman and seriously injured her boyfriend. A jury in Miami federal court found that Tesla was partly to blame for the collision in 2019. Tesla says it'll appeal the verdict, adding that decision is a setback to its efforts to develop life-saving auto technology.
Let's stick with autos. BMW says its new electric SUV will be competitive in every market, including in China, which already faces, of course, intense competition. The CEO also told us exclusively that the car maker is close to reconsolidating its dealers in China. Have a look.
Well, we're not waiting for the Neue Klasse, which hits the market in China in the second half of 26. So shortly after we launch it here in Europe. We're not waiting until that car is launched over there, because a lot of capabilities, especially on the digital side, you will already see currently in the cars. So we will see fairly stable volumes, maybe a little bit less than last year, but China is already stabilizing for us. And then, of course, that will give an additional growth momentum in China when this car launches the car. So we will be fairly stable this year, and by the end of next year we will see some growth there. We're very sure, especially because this is also a symbol of the renewal of BMW, a completely new user experience, which is quite unique also in China. You know,
in China, the competition is intense, particularly when it comes to the software and it comes to the technology. You have companies like Xiaomi coming out with the SU7 priced at about $40,000. Some have described it as a Ferrari at $40,000. What gives you the confidence you can compete in China?
Past, current and future competencies we have. When you look how strong BMW is as a brand, and what you mentioned, the turndown in the industry, this was also partially intended by us, because we were retracting from markets which were not profitable, simply as that. And as everyone knows, there are market segments where you cannot be profitable. And we ask ourselves, growth itself does not have a value in itself. If it's not profitable, we retract. And what we see in the marketplace is various things. High technological advance, and we will give that answer with that car, that we're absolutely competitive in every market, including China. But we are not staying in a market which is not profitable for us. And how that will develop, how prices will develop this year and next year, this has to be seen. You know, and we already see this year stabilizing prices, and that this is partially an extremely unhealthy competition, that everyone knows that. You know.
And you have not been involved in that price-cutting competition in China. BMW has not been part of that, but you have been supporting your dealership network. Does that support continue?
You know, you're always part of a market. but we have not been continuous specific market segments where it was not profitable. At the same time, we're reconsolidating our dealer network. That's happening at the same time to what is happening in the market. And by the second half of this year, we will be through with that. We have less dealers, we have more larger dealers, we have more profitable dealers, we have more experienced dealers. So that is happening at the same time. Why is that necessary? We have been growing by leaps and bounds in China for the last 15 years. And I think maybe it's even a good thing to take a break and consolidate our business, and that is what's happening right now.
Does that consolidation mean reduced workforce, reduced headcount in China, like some of your competitors, some other automakers have cut headcount? Is that something you're doing or planning to do in China?
We also do that. If you have less market volume, of course you adapt to that. The main thing is you have less but larger dealers, which means more profitable dealers, more efficiency.
There we go. That was T-Mac there, our colleague Tom McKenzie speaking with the boss at BMW and really their efforts and maybe what their China footprint looks like in the months ahead. Coming up and staying on cars here, we'll be breaking down the latest sales coming out of the Chinese auto sector. BYD in focus there. Big drop in shares out last we checked. Tougher rules, rising competition and what that means for the EV race in mainland China. That's ahead. Plus plenty more. This is The China Show. Right, we're looking at mosquito repellent stocks on the right here. So two things to note here. One is here in Hong Kong, Hong Kong reported its first chikungunya fever case. Second is there's a full story on this, and China is deploying almost inch in size these elephant mosquitoes, these cannibal mosquitoes, to then battle what's going on there. So I guess something to keep an eye on if they're big enough.
Yeah.
April.
Yeah, getting creative to fight the virus. But let's take a quick look at gold stocks as well, because we're seeing them tracking the Friday move in the commodity. Welcome back to The China Show. Here's a look at the CSI 300 half an hour into the session. We started the session on the back foot. We're actually eking out some gains now in the sectors we're watching as part of the movers. Gold stocks are doing pretty well. On the other side of the equation, we're seeing energy counters being a bit of a drag on the mainland benchmark. David.
Yeah, on the back of the OPEC Plus story, which we'll get into, of course, in a moment there, and of course Goldman Sachs coming out and reiterating their forecast for Brent, I guess amidst the story coming out of OPEC Plus and the group there, of course, on the weekend. All that being said, of course, certainly the mood across the Asia Pacific this Monday is either muted if you're bullish, certainly risk averse, looking at how we're number one, the Treasury curve, the 2s and the 10s is trading, and us coming on the back of what the job report actually means, right? So the revisions was something that really caught the market off guard. In fact, it caught the U.S. president maybe off guard even further, arguably could tie those two things together. And we're now looking at about an 88 to 90% probability of a rate cut that starts now in September, which is, as you can see, that's now more than base case. Although yields are picking up a little bit, but it's certainly nowhere near reversing the 28 basis point or so drop in the 2-year yield on Friday. And we're still, by the way, feeling that, although we are coming off highs a little bit on APAC bonds there, as you can see, the drop that we're seeing in Japan and New Zealand today is really reflective of the catch down trade that we're seeing because of the Treasury move on Friday, which then goes into, how do we need to be looking at the path of the Fed now that it's become more difficult to price the macro outlook. And I think we had two guests early on that basically told us two different things of the same story. One is the U.S. jobs report, and this is out of Morgan Stanley Chetan's Ahya, I'm paraphrasing what he said here, It's a reminder that while the trade deals that we're seeing right now is good news, it in many ways underscores the data that's about to deteriorate even further on a month-to-month basis. And I think Morgan Stanley's point there is when you look at the amount of capital goods in the drop there within the Asian trading data, the trade data for June has really started to drop off quite significantly. And they do expect that to continue to reflect on a month-on-month basis further down the road. Now, that takes us into the jobs report, and Chris Weston, who joined us earlier this time in the last hour, and what he basically said is, you know, we're now talking 25 for September. Wait until the jobs report for August, which comes out this time next month, because that then opens up the debate for Q soundbite.
We have had these unemployment scares before over the last couple of years, and they've mostly been false starts. The next one will be very critical. You know, obviously, we looked at the level of job creation from healthcare. If you take that out, we've got poor jobs creation. And I think, yeah, the market is going to be buying volatility around that non-farm payrolls on the 5th of September, because it will potentially open up a 50 basis point debate.
Arguably, I think the investor focus has shifted from some of these inflation numbers and perhaps what we're going to get out of Jackson Hole Symposium to the growth slowdown, given how it's already showing signs of eating into the jobs market. We are seeing these downward revisions, also raising questions of how much can you trust the data and that resurfacing conversation. Are we going to see a 50 basis point cut from the Federal Reserve next month, which is, of course, what happened last year?
Yeah, and you know, how quickly does that become apparent to markets? Because we don't have the emotional bandwidth to deal with the sort of day that bond markets had on Friday. Let alone, of course, all the trade headlines that have yet to drop, of course, and that takes us into the other market theme area, which is still the lack of progress as it pertains to U.S.-China, the trade deal. And we know, of course, of this extension in the truce. Where are we on the key issues of the day, right? Rare earths, for example. And I think Jameson Greer, in fact, just commented on that. And I think incrementally, that's your new information this morning. Have a listen to how he phrased that.
They really focused on rare earth magnets and minerals. China has put a global control on the world. And so for the United States, we're focused on making sure that the flow of magnets from China to the United States and the adjacent supply chain can flow as freely as it did before the control. And I'd say we're about halfway there.
To help us unpack all this and how it's playing out in EMs, Bloomberg EM macro strategist Marcus Wong joins us. So Marcus, following the slide in the dollar from Friday, we're seeing a bit flat now, but all Asia currencies pretty much stronger against the dollar, following that weakened and expected NFP on Friday, and then these heightened bets of rate cuts. Are we back to the sell America mode?
Well, that's a very brilliant question. I think markets have been absolutely whiplashy. That's the word to use. Asian currencies, dollar was rebounding up until the end of last month. I think July, sort of first bounce in over in a year essentially, and a lot of it you could say was overextension of bearish dollar bets. But the numbers on Friday really put back into focus the bearish dollar scenario. And I'd like to emphasize that, even though some fundies we spoke to, they were viewed that the dollar bounce in the near term, but it was near consensus that there will be a bet over the medium to longer term, the bearish dollar theme would come back into play, and we are getting a reminder of that. We got a reminder of that on Friday. And also, underlying all that, it's not just, Fed rate cuts of 25 basis points or 50 basis points, but it's also the underlying theme of the sell America to trade. Essentially, Fed independence and policy continuity. And I think investors got a sense of that when, Trump fired the labor statistician after the data was released, reminding investors that, the whole concept and idea of Fed independence is always, in a sense, looking around the corner, is under threat in a sense. Although we are definitely not where we're at in April, quite a lot of trade deals have been done. Although, as you mentioned earlier, the US-China trade deal is still ongoing, but trade deals across other economies have been closed. So in a sense, policy continuity, which is another key pillar for the sell dollar team, has improved from April, but there's still quite a lot of uncertainty instead. So I think the sense in the market is that while people don't expect a huge dollar rally moving forward, the slide in April that we saw may not be so as obvious, and what you could see in the next few months or so will be a dollar in a consolidative mode. So what does this mean for investors? So quite a few investors we spoke to were quite reluctant to, for example, go into Asia, carry trades in Asia during the summer months, because if the dollar is in a consolidative mode, essentially that would be quite negative for carry and negative for investors.
Marcus, Taiwan dollar, Korean won, Malaysian ringgit may be insulated, as you point out here on your post, on the back of perhaps maybe if the dollar slides. That's a big if, of course. Why those three specifically?
Well, all those three are essentially economies with huge foreign currency deposits. For example, in Korea and Taiwan, pension funds have invested heavily in U.S. Assets over the past decade or so. So of course, when the dollar slid, and we saw a glimpse of that in May. There was a huge rush by exporters as well as pension funds to essentially hedge themselves, hedge their dollar exposure. So for Korea and Taiwan, that's especially true for the pension funds, companies as well. For Malaysia, a lot of Malaysia is a current account surplus economy, so a lot of corporates actually again had dollar deposits. Well, obviously because their returns were much better during the period of U.S. exceptionalism. But of course, with the dollar unwinding the way it has, a further hedging or further bringing repatriation of offshore dollars will essentially boost the currencies of these economies.
Marcus, thank you so much. Marcus Wong for us there. Now let's take a quick look at how oil prices are faring as well, because we did get OPEC Plus pretty much as expected, completing the reversal of this giant supply cutback that it made in 2023 with plans for 47,000 barrel a day output increase next month. Our Bloomberg oil and shipping reporter Waylon Soon is with us. So Waylon, talk us through this move that was pretty much as expected, though it is bring these barrels back to the market earlier than scheduled.
Right. So thanks, Avril. So what we hear is that OPEC is planning to bring back 547,000 barrels per day from September onwards. And then we're going to see a pause. So what essentially this means is that they have brought back what they've committed to, over 2.2 or 3 million barrels per day. And that's a pause. But what's left on the table is 1.66 million barrels per day. And the traders are looking for signs of what OPEC is going to say at the September meeting. But for now, it seems that the supply glut for oil is in focus, as we can tell from Goldman Sachs and Wall Street banks retaining the oil price forecast. So they've baked all of this into the oil price forecast. We are seeing oil expected to trend downwards towards around $65 per barrel. And why is that so? Because we think that the global economy is going to weaken from here on out. We're past peak summer demand for oil. As we've mentioned earlier, we have the trade deals, the trade tariffs that Trump is going after, and all these as to a weaker global demand picture for oil.
Yeah, and it's showing up in U.S. jobs data, it's showing up in some of the Chinese economic indicators as well. We still have some lingering questions, though, because OPEC didn't really provide that clarity on 1.66 million barrels per day. So how are you viewing that aspect?
That's right. So we think OPEC might be keeping its cards close to its chest because there's still this issue of the Russia war in Ukraine and what Trump is doing about that. He has intimated more aggressive tones, or maybe hinting at possibly ending the war come what may. So there is that overhang of sanctions, maybe potentially more of those on Russia, maybe more on Iran too. As we have seen last week, the Trump administration has come out with a huge package targeting Iranian oil exports. So sanctions are still pretty much in focus, and I think this is what traders are concerned about. And for OPEC to not hint what it's going to do at September, I think it's sitting there trying to see what else could come in the coming months ahead and react accordingly.
leaving some of that optionality, I guess, for them on the table. Wei Lun, thank you so much. Wei Lun soon for us there. Still ahead on the China Show, we'll dig into what Hong Kong's new stablecoin regime means for the city's crypto hub aspirations. Animoca brands and CertiK join us next. This is Bloomberg.
Welcome back. Let's turn our attention now to the auto space, India specifically, where you have Vietnamese EV maker Vinfast launching its first factory in India. Now, the company is aiming to get this 35 dealerships across India in at least 27 cities by year end. Quite a rollout there. Joining us exclusively is Pham Chau, Asia CEO at Vinfast. Mr. Chau, thank you so much for joining us. And again, we were talking just before we came on air on quite an eventful day. Just help us understand how you guys got here to this point, how quickly we're now here, and what your initial targets are for this plant.
We are very delighted and excited to open our first ever plant outside Vietnam today in India. And it took us 15 months to be able to complete this factory. And we are pleased to see the huge development. Sometimes we think that we are able to make from the impossible into possible. And this is the first stage of our three phases development plan in India. This first stage, we have 50,000 units per year, and we try to scale up 150,000 in the next stage. And everything is all set to launch our vehicles this month, only in August. We are going to launch officially the car, announce the price, and now we have quite some bookings. So we are always set to deliver the car for the customers before the festive seasons begin.
Okay. Well, it seems like things are moving quite quickly to the point you're making there. I think you mentioned some figures just now in terms of the initial capacity of the plant and how you plan to increase that into the future. Give us a sense really of how large this plant is at the moment.
Yes, we plan first for this year is a few thousand vehicles to be launched, and we focus on VF7 and VF6. The reason why we launched our brand by VF7 and VF6 because we want to position ourselves as the premium global car maker, which is also accessible. In other markets, like in US and in European Union, we have launched our VF8 and VF9. Whereas in Southeast Asia, we launched VF5, VF6, and India, we decided to launch VF7 in order to target the mid-segment. That's number one. Number two, in India, we apply the strategy of CKD. We don't import CBU to start our operation, but we wait until today we complete our CKD factory. And from now on, we will deliver our car, which are CKD here in India. And number three, we are going to build the whole ecosystem here, what we call the 5 branches ecosystem. Number one, we build the plant. Number two, we develop a network of dealers, as you just mentioned, about 32 dealers across 25 cities. Number three, we are going to build a whole ecosystem of V-Green of our charging point. To make sure that the charging point of V-Green will be available to our Vinfast customer. Number four, we are about to bring in our GSM, which is a taxi and health riding company to promote the use of the EV. And number five, eventually, we also bring in our Green Future, which is a rental company. So we create the whole ecosystem to back up our sales of EV. In addition to the ecosystem of Vinfast, we are about to bring in also the whole ecosystem of Vin Group, starting with the smart city of Vin Group, with the green energy, VinPearl for the hotel, VinMake for the hospital, and VinSchool for the schools. So the whole school and the whole ecosystem back up our brand.
That sounds like a comprehensive plan that might cost a lot of money. I need to ask you, have you secured all the financing you need for everything?
Oh yes, we have vision to build the whole ecosystem in India. Subsequently, we are in discussions with all the banks and private equities and investment banks, and all is set.
Understood. And if you could give us maybe a ballpark figure, how much do you think you'll need for everything?
So for the time being, we have a long-term commitment to invest in our ecosystem. For the plan, it's a long-term. We have a commitment to invest here $2 billion US. The first phase is 500 million US dollar. Of course, we enjoy the support from the local government and as well as the federal government in various incentive schemes, and that is for our factory. And for the development of networks, cell networks, we have been signed up with 5 major banks. We have signed MOU with them. We are going to announce very soon after the inaugurations of our plant today, and they are ready to support our dealer financing as well as retail financing. For the big green, we are also in discussions with a number of private equity and banks in order to support that system. That's what we have done in Indonesia, in the Philippines, and for other projects, we are waiting until the finalizations of the feasibility study, and then we start the negotiation with our potential banking partners.
Thank you for the clarification on the financing part. I want to ask you now about strategy on the ground in operations. As you know, this is a very competitive market. The numbers we put out, 35 dealerships across the country in at least 27 cities by year end. Do you plan on doing this by yourself, or are you open to local partnerships to be able to penetrate this market quicker?
In principle, we are open to all possibility of partnering. But for the time being, we think that we have enough requests and applications for dealership across those 27 cities. Even we have more than enough in order to prepare for our next phase of expansion in 2026. So basically, I think all is, we feel very comfortable with the pace we are doing it at the moment. So partnership, yes. Joint venture, let's see what kind of joint venture. So at the moment, we feel very at ease and comfortable with the space that we are moving for the time being.
Understood. I want to ask you then about the VF6, VF7. You point out, of course, these are your initial forays into the market. Have you thought about pricing strategy in those specific product categories for those 2 models?
Yes, we have conducted a survey. Before that, we did a market survey for our feature list, and we tried to localize the feature list, make it sure that those feature lists will meet the expectation of the Indian customers, number 1. And number 2, we realized that India is a very price-sensitive market. Therefore, we have analyzed what is the best price that we are going to launch. We think that it will be very competitive. We are going to announce that in a few days to come after the inauguration of the plan. And we also, during that ceremony, we also reveal the feature list of VF7 and the VF6. So please give us some few more days, and you will see what are the prices that we are going to come up with.
Sure. We look forward to the announcement in a couple of days. Mr. Chau, I guess a broader question on competition. How cognizant are you over the competitive advantages that Chinese EV makers might have, and how do you plan to combat that competition?
In theory, we don't see any EV maker as our competitors. We see ICE car as our competitor because we have a mission of making this planet greener, and we are supportive of a smart mobility, advanced technology. Therefore, we don't see any EV maker company or like Chinese EV maker as our competitor. That's number 1. Number 2, we come into India as well as in other markets with our 3 core strategy. Number one, a very good quality. Number two, affordable price. And number three, excellent after-sales service. And in addition to that, we are backed up by the whole ecosystem of Vinfast. As I share with you, it's not only the quality of the plan, it's not only the quality of the affordability of the price, but also the whole ecosystem of the third-party workshops. We built 120 workshops across the country for this space. And in addition to that, we'll be back about our own lineup.
Mr. Chau?
All lineup. Yes.
Mr. Chau, that's all we have time for. Thank you so much, and we look forward to hearing updates from the company, including, of course, in a few days, of course, the pricing there. Pham Chau, Asia CEO at Vinfast. All right, it's actually quite quiet across these markets, and I'm not going to spend a lot of time on it because we don't have a lot of time, but the bottom of your screen tells you everything you need to know about these markets about an hour into the session. Welcome back. You're watching the China show. There's no let up in this weather in Hong Kong. It's gotten to a point where, you know what, if you don't have to be outdoors, it's quite challenging out there. Black rainstorm warning on Saturday. I think you had a similar but not quite a black, I believe, yesterday. And this time, and just this morning, amber rainstorm warning, but then that signal has been removed, but still, as you can see, it's still going to be quite a rainy session and unpredictable weather, I think, as the Hong Kong Observatory has outlined for us right after, of course, that typhoon which hit us. I'm losing track of time now, about a week back or so. Right. Now, let's get a sense of the big stories across Hong Kong. It's what date is it? August 4th, which means that clearly a couple of days into August. It's also a couple of days since August 1st when we had the stablecoin regime beginning here in the city. If you want to have more information about that, of course, we'll get you that roundtable in a moment. But certainly the HKMA has now put out those guidelines and what that means as far as licensing, the deadline for licensing, what you need to be a licensee, and perhaps what the next few weeks and months are going to be. Okay, actually, you know what? Well, I mentioned that, just to correct myself, amber rainstorm is up again, second time this morning. Okay, there we go, how quickly the weather changes. So, yeah, umbrellas, rain boots, is that your thing? Or cheap shoes, as they say. Okay, let's take it back to stablecoin. So you have Asian markets, of course, updating their stablecoin rules. For one, you have President Trump signing into law this U.S. dollar-pegged cryptocurrencies, and that law there that has certainly intensified, number one, and number two, instilled a sense of urgency among the region's authorities, including, of course, what I mentioned just now here in Hong Kong. Let's bring in Ryan Weeks, our senior APAC crypto editor, with us out of KL today to talk us through this. Yeah, it's the race is on, Ryan, as they say.
It is, yes. It's very striking. There's a lot happening across Asia. I mean, just to take a step back, stablecoins are a type of cryptocurrency pegged to an established fiat currency, and the dollar absolutely dominates the stablecoin market. I think there's more than $250 billion worth of US dollar-pegged stablecoins out there in the market. Very little by comparison of any other fiat currency. And, you know, that market is forecast to grow to something like, well, more than 2 trillion, I think, with Trump getting behind stablecoins in the US. So across Asia now, you're seeing markets, they have to respond, and authorities are drawing up legislative regimes for potential issuers all across Asia, including, as you said, in Hong Kong.
Yeah, and, you know, we're now a few days past that, effective date, August 1st. What do we know about the guidelines here in Hong Kong out of the HKMA, Ryan?
Yeah, so in Hong Kong, I think they're particularly looking for companies that envisage a sort of a practical use case for stablecoins, whether in payments or cross-border remittance or something like that. And they'll put a lot of emphasis on, authorities put a lot of emphasis on whether potential issuers have sort of realizable plans for stablecoins, as far as I understand it. And yeah, you know, right across the region, I think companies feel compelled, countries feel compelled to do something because people in Korea or Hong Kong or wherever it may be, they're already trading stablecoins, but they're trading US dollar pegged stablecoins. And in some ways, or at least in some cases, that's happening in an unregulated way. So, there are fears of capital flight in these countries, but I think it's what authorities are now thinking about doing to try to control that is licensing local firms to issue currencies pegged to local currencies, whether it be the won or the Hong Kong dollar or whatever, and then they'll have more oversight over the stablecoin space, and they'll hope that they can better sort of control capital flight risks.
Yeah, and certainly light touch is certainly not the press release as far as some of these jurisdictions are concerned. Ryan Weeks, thank you so much for the overview there. Our senior editor on crypto, joining us out of Kale. Let's get into the weeds of things here in Hong Kong. Joining us now on this roundtable coming up is Zipse, co-founder, executive chairman, Animoca Brands. Of course, you may know him already, which has participated, by the way, in the HKMA stablecoin sandbox as part of that JV. He joins us out of Singapore this morning, and here on set with us in Hong Kong is Esme, head of capital markets and strategic intelligence at blockchain and smart contracts cybersecurity firm CertiK. Okay, Zipse, let me start with you. The guidelines are out. Anything that stood out to you so far based on your initial glance there?
No, I mean, I think a lot of what was discussed already earlier, and the plans are sort of known. And it's going to, initially, we're looking at the Hong Kong dollar, and of course, it's currency-backed, 1-to-1, which is basically the expectation. I think you can view this first phase of the stablecoin rollout as really still part of the extending of essentially experimentation as well, making sure that things are moving well, kind of like, walk before you run type of approach. But also, we should also bear in mind that things are moving faster, as was previously mentioned, just because of what's happening in the US, because the counter-response, of course, what's happening in the US, especially with the Genius Act, is that you should expect that every major bank in the US is probably going to be issue a stablecoin of their own. And then, of course, Hong Kong is actually slightly ahead of the game in that actually it passed legislation a little bit earlier. But every place that has major global trade is going to have to do something on stablecoins, because imagine if you're doing business with the US or in the future with Hong Kong, you have to be able to receive the stablecoin. And if your local legislation doesn't allow that, then you actually can't do business with that area. So we see quite a bit of adoption in the area, but nothing in particular that stood out to us that wasn't already known from previous discussions and consultations.
Right. Esme, let me bring you in. Your thoughts on the same question. Anything that stood out to you so far now that the floodgates are open and now people can start accelerating their own plans?
Right, sure. I would say that for HKMA stablecoin ordinance, so it's an excellent piece of work. And the reason I say that is for two reasons. So first of all, it's very forward-looking. So already embedded in the details would be number one, that there's going to be multi-currency stablecoins that might be a possibility in the future. And then the second is that it's also very commercial. It already guides a lot of the applicants to focus on different use cases. And I think ultimately stablecoin is a scale game. So it's again, tying back to Yat's point, so it will be the regulated players like the banks and also the tendering issuing banks who will be first to get the license.
Yeah, and I guess to the point you're making there, Esme, just to follow up on that, it's a scale operation to your point. What do you think the next phase of that scale will look like? Is that going to be beyond the Hong Kong dollar? Is that going to be just big players getting the license? How does that look to you?
Right. I would focus on cross-jurisdictional alignment. So I think the name of the game here would be, again, about scale. So there needs to be passporting and for there to be optimized cost of market entry for different jurisdictions. So again, with US having its Genius Act and also with Korea, Hong Kong, and also MiCA and the EU having related regimes. So I think it will be very easy for different players to passport into different jurisdictions. And that again ties back to easing the cost of entry. I do want to add one point, and it's that with Hong Kong being the conduit of capital flows between Beijing and also the rest of the world. So a renminbi denominated stablecoin, which is a possibility, would be a very attractive proposition.
Yet, on that last point that Esme just brought up, is that, you think, a tokenization of the renminbi, let's put it that way, is that, you think, the end, potentially the end goal here? What do you think?
I mean, I think that's certainly what a lot of people are excited about. Obviously, that's not in the cards at the moment. There's a lot of things that obviously need to be worked through. But if you consider, for instance, that Hong Kong has always really been the financial gateway for China in one form or the other, when you think about what's happening with renminbi in Hong Kong or dim sum bonds, for instance, it makes sense that sometime in the future there should be a consideration around that. But I think the one thing I also want to point out that the part here is about global trade and finance as something that is around influence as well. If you look at what's happening with the US dollar stablecoin, how many countries in places like South America or in Africa, for instance, are now all using US dollars because of stablecoins? They don't necessarily need a bank account to be able to interact with essentially the US dollar. You can certainly imagine that other countries around the world, including Hong Kong, will be looking at how to extend their global trade. I mean, Hong Kong has always been a global trade center. It's always been a finance hub for that. How do you extend that reach and that influence? And that comes through stablecoins.
Right, and that brings up another aspect of this yet, and I want to get your thoughts as someone who's actually part of just the overall ecosystem here. How does this affect anti-money laundering, and what requirements do you think will be necessary to ensure, of course, that that those holes are plugged? And in terms of the licensees being able to meet those requirements, do you see that as being a potential challenge short term, if you're not a bank, of course?
I mean, so of course. So first of all, I mean, I think to Esme's point, I mean, obviously the banks, and we're joint ventured with Standard Chartered on this effort, are obviously going to be a big part of this. But look, I mean, KYC, AML, the regime doesn't change just because you're a stablecoin, right? And even today, in the whole Web3 crypto space, we're already doing KYC and AML when we onboard people. The one thing that I think a lot of people often don't understand about our space is that it's actually much easier to track what happened with the transaction. So, in a way, in the traditional finance world, you trust the bank to tell you, I've done the work. But actually, because of the blockchain, you can trace all of that. And so it's really a question of, how far do you want to trace back? But you can trace back really literally the original origin when it's coming out of exchange on an on-chain transaction. So blockchain actually adds more transparency. And so I think KYC and AML regimes will largely stay the same, but will probably become more optimized and perhaps even more interoperable.
Esme, let me bring you back in. In terms of everyone's now waiting for who are the groups that are applying for the license. They have, I think, until the end of September to be able to put in that application with the HKMA. What are your expectations here in terms of how many groups are going to put in their applications here? Is it going to be a flood or very, very slow handful of applicants here?
Right. I would expect that to be the floodgates are open, obviously. So I expect a lot will go in. But I think the key question is who's going to emerge as the triumphant licensee, right? Okay. So on that point, I think the most important would be, again, platform economies, which is unique in Hong Kong's jurisdiction. So we already see that different stablecoin sandbox players, for example, Ant and also JD. So they in the game of, say, trade settlement, globalization, and second, around fintech. So I think these are the potential players that could potentially get a license as well, in addition to the consortium and also with different banks.
I want to get a sense of, I forget where I read this, and I apologize if I'm not being completely sort of accurate on this, but is it by invite only if you want to apply, or has the HKMA put out criteria that is transparent enough for as long as you meet capitalization and all the other requirements, are you free to put in an application? What's your understanding of the application regime?
Right. I would fear towards the latter. So HKMA has already put out a very clear regime. Okay. And the number one thing would be obviously research. The second would be having the ecosystem requirement, which includes business use case and also viability. So HKMA has laid out very clear rules. At the same time, because of the whole passporting phenomenon, so a lot of global tier 1 stablecoin issuers will be slated to be putting in an application as well.
Okay, can I ask you, this is completely out of curiosity, but I guess a natural progression of the conversation. Are you guys interested? Have you put in an application?
Oh, well, certainly interested. I mean, I think we're one of the 3 sandbox participants. So, our joint venture with Standard Chartered and Hong Kong Telecom was one of the participants together with JD and RD. So, of course, we're interested. Our plans yet to be announced, but obviously that's something very important for us.
Sure.
I would also say that the mental model to think about stablecoins in Hong Kong is, I don't think of it as something that, even though, we know a lot of companies are going to try to apply for it, I think, the HKMA put out a statement, actually, I think it was last week, sort of, warning people a little bit about, look, it's probably better for you to consider partnering with them, with those stablecoin partners, because there's a little bit of, basically sort of, I guess, exuberance in the market, which, is something that some parties might be concerned around. And I think the mental model to me is a little bit like 5G licenses. And again, it's not an exact parallel, but it doesn't really make sense to put out 50 or 100 stablecoin licenses, right? You want to be very strategic. It has to be companies that have good capital, good access, know the technology, and also be able to sort of present the type of capital flows and security around that. So this isn't just for everyone. We're talking about dealing with money here, and that is sovereign. So this is something again that's going to be much more tactical. So for those who are looking at companies in the space, look at the companies who actually have the credibility in the space and have also the know-how and have worked in the space for a while. So I think there's just a handful of them for the time being. But overall, very positive, of course.
Of course. Yat, final question, in fact, for both of you. But Yat, let me pose this to you first. The notion that we overestimate the short term, but we underestimate the benefits over the longer term, particularly when it comes to technology. You're the expert here. In this specific case, what are the underappreciated opportunities you think that people are sleeping on?
Gosh, I mean, you just have to, I guess one perfect parallel in our space is just look at the price of Bitcoin as a perfect sort of parallel of sort of, underappreciating and sort of, potentially overappreciating at certain times. But in any extent, sort of cross-border trade is going to be a massive one. Also, the other thing is around sort of mass financification of various industries around this, right? Stablecoins doesn't just represent the access to trade. It's the way that people get into the sort of Web3 and crypto arena. So when you're buying a stablecoin, you're going to be using it not just to use your sort of day-to-day sort of business in certain countries, because in some ways you already have that. It's going to be opening up the digital economies. That means buying more tokens or more digital assets or maybe other forms of online advertising. And if you consider how much time we're spending online today, which is basically the majority of our time, most of our commerce and activity in the virtual sense is already happening digitally. And stablecoins is going to be that venue. So really what stablecoins will do is it's going to completely expand, and in our way sort of we think of it as a Cambrian explosion of digital activities that are digitally native, as in things that are on-chain. So stablecoins is going to be a huge mass on-boarder for the broad sort of, call it Web3 digital asset space. And I also think it's going to create a lot more mass adoption in terms of financial literacy. Think about how many people understand money and finance. It's not a lot of people out there, because the daily activity that they do online aren't actually captured around that. Like, for instance, we're doing student loans on-chain, which stablecoins are perfect, as an example. So students today are already receiving their loans in places like Philippines or Indonesia through Web3, through stablecoins, right? As opposed to a bank account, which has more restrictions. It can also reach into villages or places where people who don't even have a bank account. Right, so these are perfect use cases, and there's billions of people who are not even financially included yet. They're going to all go online, and they're not just going to be online because of a phone. They're going to be financially included. So it's going to add a lot more liquidity, a lot more growth in the market, and expansion in this industry.
Esme, same question. Opportunities that you think are underappreciated, and what's the advice for companies that are looking to adopt/issue?
Right. First of all, I do agree with Yat's point that stable coins or digital assets is a positive-sum game. So every stakeholder in the ecosystem stands to benefit. But I think what comes out as the failure accretive and also the failure capture along the stablecoin value chain. Going forward, I think we're going to shift from the issuance layer, which is a stablecoin issuers, to the application layer. That's very similar to phenomena in innovative technologies, such as what we see for AI. So we see that right now the value is shifting from issuance and also ecosystem compute all the way to applications. So just to cut to the chase, what's going to benefit? Number one will be cross-border settlement. Second will be fintech players that directly own the client relationship and also the user base.
Fantastic. Thank you so much to both of you for taking the time to help us really understand and translate this into English, a lot of the Greek letters out there. Yat Siu in Singapore, co-founder, executive chairman. Thank you at Animoca Brands, and Esme Pao here in set with us, head of capital markets and strategic intelligence at CertiK. Okay, an update out of Singapore. You might have seen it already. Billionaire Ong Sanh has pleaded guilty to abetting obstruction of justice. That's what we know so far. We're still waiting for more details, but we will leave that idea with you for now, and we'll get you guys updated, of course, once we have more information out of Singapore. Plenty more ahead. This is The China Show. Welcome back. Car makers on your screens. 2% is not bad given how we opened the day at more than 3% drop, specifically on BYD here. Well, sales barely grew last month, raising some doubts, at least some challenges about whether or not the Chinese EV maker will actually meet its annual target. For more context here is Danny Lee, our transport reporter, to put these numbers into context for us.
Yeah, BYD sales year on year barely grew, less than 1%, but from the previous month down 10%. And that just raises questions. It has a big amount to climb if it is to reach its 5.5 million annual sales target for this year. So it now has a run rate. It needs to sell 600,000 units for the rest of the year in each month. And that's a really tough figure for them because they've only sold a record of 515,000 previously as a prior high. So this is a tough kind of mount for them to climb, and you can see the share reaction. It opened a little over 4% lower at the time, pulled back a bit, but when you then see the rest of the market, BYD has underperformed the rest of the marketplace, basically.
So is the rest of the market doing better then, like in terms of that one data point, and how does it set those competitors up for the rest of this year?
Yeah, I mean, we are seeing a higher level of competition, and we shouldn't be too surprised that the sales numbers in the summer period, particularly July, should be a little bit more muted. But when you look at the likes of Stellantis partner, the Motor, you also see Chau and Xiaomi, they're all still rising. They're hitting record monthly sales, even though they're on a smaller base, but they're still doing better and competing more effectively. We are seeing a few others like Li Auto falling 40% in terms of sales numbers. Then we also see the likes of, you see a few others like NIO also struggling. So, there's a bit of a mixed bag, but you can still see who are the winners and very much the losers.
Yeah, and I think to your point, in BYD's case, the bar has been raised so high that they need to almost strike a PR almost in every month to be able to meet the target. Okay, I'm wondering how the company then manages guidance, if that is a future topic of conversation there. Danny, thank you so much. Danny Lee, our transport reporter. Plenty more ahead here. Actually, not plenty more ahead. We're almost done with the show, but there's plenty more ahead here on Bloomberg Television. This is the China Show. Welcome back. Before we go, just a look at some of the big movers out there. 2.4%, as you can see, on shares of PopMart. Morgan Stanley is out with a note suggesting buy on recent weakness. There we go, one of the outperformers today, although certainly the bullish call around PopMart is not something new. That's about as fresh as previously frozen grocery sushi, as they say. New Oriental is one stock we're tracking on your screens. That's also an analyst called ABC International, reducing that one, cutting that to hold. 35.82 right now in shares of New Oriental. Big earnings week coming through, so CLP is today. In the rest of the week, we'll hold a lot of the Swire Group is reporting, so you have to keep an eye on that. I think MGM China, the casino player, of course, is coming out with some earnings. SMIC, Hua Hong Semi are also coming out in terms of if you're not able to make out the logos. Quite obviously, on the screens, Cathay Pacific, there we go, spelled out. And Swire Pacific are set to report results this week. Speaking of airlines, for the first time in 5 years, stay tuned, of course, when Thai markets open up in the next hour. And we have Thai Airways set to resume trading after that restructuring. Well, details on your screens on that. And we'll see how the market absorbs the trading here of Thai Airways. That comes, of course, in a couple of minutes going into the rest of the session. That's it from us here on The China Show. We will see you all tomorrow. It's a big week ahead. The night is young. We're going into the last 30 minutes of trade in mainland China. We're off a little bit, 0.1%. This is Bloomberg.